A $1.2 million call purchase looks bullish, but the exact same print could be a hedge, one leg of a spread, or part of a book that is still heavily short. The scanner sees the trade. It does not see the story. So before you call this smart money loading up, watch what the headline leaves out. Here is the trap. The same 5,000 contract call buy dropped into 4 different portfolios. On its own, it is bullish, about 175,000 shares of upside. Paired with a higher strike sale, half of that. Inside a conversion, basically flat, and bolted onto a short stock position, it flips completely. About 325,000 shares net short, same print, opposite bet. This is where scanners confuse people. One trade is really 3 sizes, and they answer 3 completely different questions. The premium, the cash actually at risk, is 1.2 million. The delta adjusted exposure, what it behaves like right now, is closer to 17.5 million. And the gross notional, the full deliverable, is 50 million. So when someone says 5,000 contracts, ask which number they mean. First trap. Volume only counts how many contracts changed hands today, not how many new bets exist. Look at the next session instead. If open interest rises and implied volatility rises with it, that looks like fresh demand. If open interest falls, somebody was quietly closing. Even then, it is aggregate evidence. It tells you what happened to the whole line, not which trader did it. Second trap, and this is the one that fools people the most. A complex order is priced as one package, but a scanner often shows you a single leg, usually the loud, bullish-looking one. That $3 million call buy might have a quieter, higher strike sale printed in the very same instant. Together, they are a defined risk spread, capped above 115. So before you call it bullish, find the matching leg. Third trap. Sometimes the move comes from the seller managing inventory, not the buyer knowing the future. A dealer left short those calls is short gamma. So as the stock rises toward the strike, it will often buy more and more shares just to stay hedged, and that buying can reinforce the move. But watch the limit here. This loop only runs while the dealer stays unbalanced. Offsetting flow can cancel it entirely, and a public gamma number is a model estimate, not an X-ray of anyone's book. Now let's test this on a real one. Summer of 2020. SoftBank reportedly bought roughly $4 billion of US tech call premium. Gross exposure in the tens of billions. The clean retelling, one whale ran the Nasdaq, is too simple. Later reporting describes spreads, rolls, and risk reversals. The fair read, that demand likely added to dealer hedging in a market already running hot. Gross notional is not directional risk. And here is the one everyone gets wrong. Every quarter, the JPMorgan hedged equity fund resets one of the largest scheduled trades on the tape. Glance at one leg, tens of thousands of index puts, and it looks like a crash bet. It isn't. The fund already owns the stocks. This is a 3-leg collar, a put for protection near -5%, a deeper put sold near -20 to cheapen it, and an upside call near +5 to finance it. Predictable in purpose, variable in strikes, portfolio maintenance, not a forecast. So here is your checklist for the next whale alert. 1. The contract. Size it 3 ways. 2. Inventory. Is the exposure new, confirmed by next day open interest? 3. Structure. Hunt for the other legs and rebuild the package. 4. Purpose, direction, hedge, yield, or a scheduled roll. Assign odds, not a label. 5. Transmission. Do implied volatility and the tape actually agree? Remember the rule. Options flow is evidence of positioning, not proof of direction. Run those 5 passes, and that JPMorgan collar stops looking like a crash bet and starts looking like exactly what it is. If this changed how you read an options alert, do one quick thing: subscribe to Market Decode and tap like. One clear market story every single day.